Imagine America in the 1870s, just a few years after the Civil War. It was a nation rebuilding, eager to expand, and utterly captivated by the promise of progress. The Industrial Revolution was roaring, new technologies were emerging, and the entire country was gripped by an obsession with one incredible innovation: the railroad. This wasn't just about faster travel. It was about connecting a vast continent, unlocking untold wealth, and forging a new American identity. Everyone wanted a piece of this economic boom, believing the good times would never end. Railroads were more than just iron horses. They were the arteries of the nation's future. They promised to link raw materials to factories, farms to markets, and isolated towns to thriving metropolises. Fortunes were made, and more importantly, believed to be made, by those who invested in these ambitious projects. Land values soared along proposed routes, and every new line seemed to guarantee immense profits. This era of explosive growth, however, masked a dangerous underlying current of unchecked ambition and rampant speculation, setting the stage for disaster. At the heart of this gilded age of finance stood a man whose name echoed across the continent: Jay Cooke. He was a titan, revered as the financier of the Civil War, having successfully sold billions in government bonds to fund the Union effort. Cooke was a master of public finance, a visionary who knew how to tap into the patriotism and pockets of ordinary Americans. His reputation was impeccable, his methods innovative, and his influence immense. He seemed unstoppable, the Midas of American banking, turning everything he touched into gold. After his wartime triumph, Cooke turned his attention to the biggest peacetime project imaginable: the Northern Pacific Railroad. This wasn't just another line, it was a grand vision, a second transcontinental railroad stretching from Lake Superior all the way to Puget Sound, spanning 2,000 miles of rugged wilderness. It promised to open up vast new territories, unleash unprecedented economic potential, and solidify America's dominance of the North American continent. Cooke saw it as his legacy, a monument to American enterprise and his financial genius. But this vision came with an astronomical price tag. Building 2,000 miles of railroad through mountains, prairies, and dense forests required an unprecedented amount of capital. Engineering challenges were immense, labor was scarce in remote areas, and the logistics were a nightmare. The estimated cost ran into the hundreds of millions of dollars, a staggering sum for the era. Cooke's company, Jay Cooke Company, was tasked with raising this monumental amount, making it the largest private financial undertaking in American history up to that point.
How did Jay Cooke plan to fund such a colossal undertaking? Through a vast and ambitious bond-selling campaign. He leveraged his wartime success, appealing directly to the public through a nationwide network of agents and powerful advertising. He promised generous interest rates, framed the investment as a patriotic duty, and painted a vivid picture of the riches that would follow. Millions of Americans, from wealthy industrialists to small-town savers, bought into the dream, eagerly pouring their money into Northern Pacific bonds. Initially, the strategy worked brilliantly. Money flowed into Jay Cooke Company's coffers, and construction began with fervor. The public's trust in Cooke was immense, and the initial bond sales were a testament to his persuasive power and the nation's boundless optimism. The narrative was simple: investing in the Northern Pacific was investing in America's destiny. For a time, it seemed as though Cooke's Midas touch was still firmly intact, and the railroad was destined for glorious completion, bringing prosperity to all its investors. However, the reality on the ground was far grimmer than the prospectus suggested. Construction was slow, expensive, and constantly plagued by delays. The vastness of the American West proved more challenging than anticipated, and settlers were not flocking to the remote Northern Pacific territories as quickly as predicted. The line was building into what many skeptics called Cooke's Folly, a wilderness without immediate population or resources to generate the necessary traffic. The projected revenues were nowhere in sight, and the dream began to show cracks.
As bond sales began to falter, Jay Cooke Company found itself in an increasingly precarious position. To keep construction going, Cooke's bank started using its own capital and reserves to purchase unsold Northern Pacific bonds. This meant the bank was becoming dangerously over-leveraged, with a disproportionate amount of its assets tied up in a single, increasingly risky venture. They were effectively borrowing short to lend long on a speculative project, a classic recipe for disaster when confidence begins to wane. By the spring of 1873, the warning signs were flashing red. Investors were growing wary, bond sales slowed to a trickle, and the market for railroad securities was becoming saturated. The promise of quick riches had faded, replaced by mounting anxiety. Rumors of Cooke's financial strain began to circulate through Wall Street. Every day, more and more funds were needed to sustain the railroad's construction, but the well of public investment was rapidly drying up, leaving the bank dangerously exposed.
The nervousness was contagious. Other banks and financial institutions, seeing Cooke's struggles and the general oversupply of railroad projects, began to tighten their lending. They called in their own loans to Jay Cooke Company, further exacerbating the bank's liquidity problems. The interconnectedness of the financial system meant that one crack quickly created pressure throughout the entire edifice. The air on Wall Street grew heavy with apprehension, as everyone watched to see if the Titan would stumble. Compounding America's woes was a financial tremor spreading globally. Across the Atlantic, Germany's post-Franco-Prussian war boom was cooling, and speculative bubbles were bursting in Europe. German investors who had poured capital into American railroads began to repatriate their funds, pulling crucial money out of the U.S. economy. This reduction in foreign investment further strained American banks, already struggling with overextended loans, effectively cutting off a vital lifeline for projects like the Northern Pacific Railroad. The true catalyst for the global contagion, however, came from the Austro-Hungarian Empire. In May of 1873, the Vienna Stock Exchange crashed, triggered by over-speculation in real estate and railroad projects. This panic quickly spread to other European financial centers, revealing the fragile interconnectedness of the world's capital markets. The distant crash sent shockwaves that inevitably reached American shores, further eroding confidence in all speculative ventures, especially those as ambitious as Jay Cooke's railroad. Back in the United States, the European troubles amplified the domestic unease. Rumors, always the accelerant of panic, began to swirl around Jay Cooke Company. Whispers of their inability to meet obligations, their deep entanglement with the failing Northern Pacific, circulated like wildfire. Confidence, the bedrock of any financial system, was eroding at an alarming rate. Depositors, fearing the worst, began to queue outside Cooke's offices, demanding their money, signaling the dreaded start of a bank run. And then, on Thursday, September 18, 1873, the inevitable happened. Jay Cooke Company, the celebrated financier of the Civil War, the symbol of American enterprise, closed its doors. The news hit Wall Street like a thunderclap. The Titan had fallen. It was a moment of profound shock and disbelief, a turning point that instantly shattered the illusion of endless prosperity. The closure of such a prominent institution signaled that the financial system was far more fragile than anyone had dared to imagine.
Chaos erupted on Wall Street. News of Cooke's collapse triggered a furious selling spree. Other banks, heavily invested in railroad bonds or reliant on Cooke's liquidity, also began to fail. Fearing for their own solvency, frightened depositors rushed to withdraw their savings from every institution, sparking a chain reaction of bank runs across the city. The financial district plunged into utter pandemonium, a frantic scene of shouting brokers, desperate investors, and the grim reality of financial ruin descending upon the nation's economic heart. The situation became so dire, so uncontrollable, that on September 20th, for the first time in its history, the New York Stock Exchange was forced to close its doors. It remained shuttered for 10 days, a desperate attempt to stem the tide of panic and prevent further collapse. This unprecedented closure was a stark admission of the severity of the crisis, a clear signal that the very foundations of American finance were cracking under immense pressure. The silence of the exchange echoed the fear gripping the nation. The panic quickly spread beyond the financial markets. As banks failed and credit dried up, businesses across the country couldn't secure loans, leading to immediate cutbacks and widespread layoffs. Factories ground to a halt, construction projects were abandoned, and unemployment soared. The initial financial tremor had rapidly become a full-blown industrial depression, impacting millions of ordinary Americans. The crisis was no longer confined to the wealthy speculators on Wall Street. It had infiltrated every home and every family, creating immense suffering. The railroads, the very engine of the boom, now became the symbol of its bust. Hundreds of railroad companies, many over-leveraged and built on speculative dreams, went bankrupt. Track construction ceased, and partly built lines stood as monuments to failed ambition. The dream of connecting the continent transformed into a nightmare of abandoned infrastructure and colossal losses. The financial system, having gorged itself on railroad bonds, was now choking on their default, causing even more profound economic pain. The ripple effects were truly global. The interconnectedness of world finance meant that the American panic quickly spread across the Atlantic, deepening the depression already brewing in Europe. London, Paris, and Berlin all felt the pinch as American debts defaulted and capital flows reversed. The crisis became a worldwide phenomenon, marking the first truly global industrial depression. It was a stark demonstration that in a world of increasingly integrated markets, a crisis in one major economy could swiftly become everyone's problem.
What followed was an economic downturn of unprecedented length and severity, known today as the Long Depression. It lasted for years, varying in intensity, with some historians marking its end as late as 1879 or even 1896. This extended period of economic contraction profoundly reshaped global economies, leading to slower growth, widespread poverty, and significant shifts in trade and industrial policy. For a generation, economic anxiety became a pervasive fact of life, marking a dramatic end to the era of unchecked post-war optimism. The social impact was immense. Millions lost their jobs, their savings, and their homes. Widespread labor unrest erupted across America and Europe as workers protested wage cuts and desperate conditions. The Great Railroad Strike of 1877, one of the largest labor uprisings in U.S. history, was a direct consequence of the economic suffering ignited by the panic. The crisis didn't just affect balance sheets, it fundamentally altered the social fabric, fueling resentment and calls for fundamental change. The government's response, or lack thereof, further complicated matters. Operating under a strict laissez-faire philosophy, there was no central bank to provide liquidity, no federal deposit insurance, and limited government intervention to stabilize the markets. President Grant's administration eventually bought some government bonds to inject cash, but overall, the prevailing belief was that markets should correct themselves. This hands-off approach arguably prolonged the suffering, as the economy struggled to find its footing without coordinated assistance. The Panic of 1873 and the subsequent Long Depression served as a painful, if often forgotten, lesson in economic history. It highlighted the dangers of speculative bubbles, the fragility of an unregulated financial system, and the profound interconnectedness of global capital. The crisis exposed the need for greater financial oversight and ultimately paved the way for future reforms, slowly building the case for institutions like a central bank designed to prevent such widespread devastation. Today, while the Panic of 1873 rarely features in our popular historical narratives, its legacy endures. It was a crucible that forged a deeper understanding of financial risk and global economic interdependence. This forgotten crisis wasn't just a blip, it was a foundational event that shaped subsequent financial thought, influencing regulatory frameworks and central banking principles that we still grapple with today. It proves that even the most ambitious dreams, when fueled by unchecked speculation, can shatter entire economies.